Hi everyone, I'm Sean Huntofte, and today I'm going to show you the world's first debt optimizing dashboard. What do I mean by debt optimizing dashboard? It automatically scans all the borrowing a user's doing using their credit reports and matches that against market data to automate personalized recommendations on how they can best save money. So think of it like a robo-advisor for debt. If you're a bank or another lender, I'd love to speak to you because we can help you grow your customer base two ways. One, you can lend into our marketplace and get users at no marketing acquisition cost to you. The more prices, the better. A tool like this lives and dies on price data. Or two, we can help you increase approval rates in your funnel if you're a mortgage lender. Number one costly denial for a mortgage lender is debt-to-income ratios are too high, or monthly debt payments are too high compared to income. This is a tool that quickly lowers debt payments, so it's a nice yes-if flow for mortgage lenders. So I'm just going to walk through our flow. It takes 6 questions, or about 2 minutes. All that I've done before this step is to verify an email address for an account. We aren't going to use my actual credit data. It wouldn't be too interesting. I'm a PhD, and I've spent a bit of time optimizing my debts. So instead, it's a sandbox profile called Steve Rogers, and he's going to be pretty laden with debts. So name and address you will have run into before. That's all usual stuff. Now we get into some financial snapshot stuff. So do you rent or own a home? In this case, Steve owns a home. 2 user goals that we work with today, either minimize my total expected cost or minimize my monthly cost. Income. And non-rent necessary expenses. And that's just to check if the options we're thinking of are sustainable for you. Then here's where the heavy lifting is. It's the soft credit pool. If you were a mortgage lender, you'd already have that data. What we're just doing is unlocking it, enriching it with some additional data, some questions to make sure that you are who you say you are. Okay, and now this is going to take a minute. So it gives me time to tell you what's going on in the background. So there's really 3 components here. One is the credit data. That tells us what borrowing a user is doing. We then do things like infer the interest rate, other missing pieces of data. We use trended data to figure out what you're actually rolling over on a credit card rather than just the statement balance. Then there's the market data. So here's where you come in. If you're someone who makes any auto loans, personal loans, student loans, something that people can save money with by choosing different options and choosing your loans. We're hitting you live now with direct pricing. So far we have Better and SoFi there. And then we also have indirect pricing. So we're sending out web bots. Sort of think of it like a Plaid for market data. And then the third component is adding some simple intelligence today, and it gets more complicated over time to figure out what exact options we should be choosing at the best prices to meet the user's goal of either paying their debt off faster or paying less every month. Right now we're going to stick with paying your debt off faster, and this is Steve Rogers. So magic's gone on in the background, and here you can find out how much you can save. And this is just on automatic in the background. If I'm Steve, I could get notifications every month. Or if this is a mortgage denial, it's going to be a pretty quick turnaround. Loan officers could also get sent the actionable recommendations. We launch our first nationwide mortgage denial pilot next month with a leading mortgage fintech. Here the recommendations are either with personal debts or with student loans. We've enriched the credit data over here, so usual thing that's missing and is a bit tricky is interest rates. You need that to figure out prepayment rates and everything. And then you can click into details, and here you're going to jump off into your flow if you're the lender, apply now, and we've got more details, and always try and make things as simple as possible, showing you how your total expected cost goes down, And in this case, your monthly payments are actually going up because we're switching Steve Rogers into a shorter duration loan. Also, automatic estimation of debt to income, and you can see how that changes. So, again, back to that mortgage approval use case, you have these hard debt to income cutoffs where over 45%, there's no day that you're getting a loan. Just under 45%, you're okay for a loan. And so it really matters to a mortgage lender to shift someone from 46 to the other side of 45, or the cutoff might be 36, or depending on the lending program. But a pretty typical one for Fannie Freddie is 45. And so we just help shifting that user's DTI onto the right side and let you get on with approving them, helping address disparities in home ownership, which particularly affect overly debt-burdened, lower-income households. So that's the demo. If you're interested in chatting household finance, come up to me after the conference. I'll have a booth back there. Email me anytime, sean@solve.finance. Hit our website. And again, if you're a lender interested in automating better borrowing, 2 questions you should ask yourself. 1, would I like to lend to more users? And if the answer to that is yes, then email me at sean@solve.finance. Thank you.